welcome to the CNBC-TV18 Mumbai newsroom. I'm Ekta Batra and with me is Pavitra Parekh. You're watching your stocks on CNBC-TV18. Well, it's turning out to be a session where we have seen some amount of consolidation in today's trading session. We seem to be in wait and watch mode ahead of the Fed meet and the outcome, which we will be reacting to tomorrow. So currently we have the Nifty, which is just about lower by around 0.3%. The indices largely in consolidation mode. Hi, Pavitra.
Hi, good afternoon. I think around half an hour ago or so, it got a little bit bad, right? We did slip below the 19,000 mark. The mid caps, small caps also moved into the red. So there's a little bit of recovery, but like Ekta pointed out, things are looking a little bit shaky, ahead of that big queue that we have lined up later this evening. But let's get to all of our queries that have come in because there's a whole lot. And to address them, we have Rajat, Bose joining us on the technicals and Sharad Avasthi, head of PCG research at SMIFS, to answer all of your questions as well. So the first query comes in from Shrikant Mehta. He writes in from Gujarat. He holds 100 shares of JSW Steel, which he bought at 250 rupees. So he's definitely made a lot of money on this one. JSW is currently over 720 rupees. And he wants to know whether he should hold or sell this one. Let me come to you first, Sharad, on this, since this seems like, this is someone who is willing to hold for a longer period as well. Would you say that this is a good stock to stay invested in, even considering that he's made so much money, or would you take some profits off the table?
Yeah, I think the current valuations warrant that he takes some profits off the table, maybe 30-40%. But if you are a very long-term investor and you can hold on to, say, 3-4 years or more, I think there is a possibility that beyond FY 25-26, they are talking about increasing the capacities from 37 to 50 million tons. So that would be another 35% appreciation. So I think the earnings could be somewhere around, say, 100 rupees. So if you have that kind of horizon, then it is possible that you can continue to hold on the stock for targets of somewhere around 1,000 rupees. But if you have a smaller horizon, say 1.5, 2 years or 2.5 years, I think at 700 bucks, we are expecting 60, 70 rupee kind of 60, 65 rupee kind of earning for the company in FY 26. And based on that, I think at 10, 11 times, it's roughly fully priced in. So if you have a shorter time horizon of 1.5, 2 years, it's better to partially exit or even fully exit. But if you can hold on for a longer time horizon, say for 4 to 5 years, then probably you can look at a target of somewhere around 1,000 plus on the stock.
Okay, all right, Rajat. Well, let's get you on board. What would your opinion be on JSW Steel?
Well, I would broadly concur with what Sharad had to say. What I would say that if it were to fall below 700, then definitely it becomes very weak. It can go down to something like 660, 650 kind of levels. Or else there could be a minor rally which would make it test, say, something like 750 odd levels. Around that time, one should get out of it. And I would prefer the investor to fully get out of this stock because this is showing after a distribution pattern, it is coming down. If it were to break 700, then 650 is the minimum projection. It could go even further down. So in that case, it would be better to exit right now or partly exit now, partly on a rally up to 750.
Okay. All right, let's get in another query now. This time we have a caller. We have Shruti who writes to us from Chandigarh. She holds 50 shares of PNB, which she's bought. And she's asking if she can add more shares to PNB, which is one of the stocks which she has bought at this point in time. Let's get in a quick query on that. She's bought it at around 30 odd rupees. So let's see what Rajat as well as Sharad would recommend. Well, Sharad, let's start with you because sitting on a profit, PNB, a lot of the PSU banks have been doing well. What would you recommend?
Yeah, I think further improvement should be visible in the quarters to come. We are very positive on the whole banking sector. So I think PNB should also gain traction and we could have around 15-16% advances growth for the bank. GNPAs have substantially reduced. We expect the return ratios to also improve in the years to come. And I think in 1.5 years' time, you could expect the book value to be somewhere around 100-105 rupees. And I think the price to book should ideally oscillate to around 1 time because the return ratios will also improve and the credit quality will also further improve. So I think there is a possibility that this stock can go up to 105, 110. So, and even the treasury part that is not performing right now, and we are having some losses because of interest rate movements. I'm expecting that a lot of it would reverse over the next 6 to 8 months. So that should be very positive for most banking stocks. PNB would also benefit. So I think it is a story that looks very promising in the current scenario, and I don't think that GNPs are going to create a problem in the near term. And mostly the retail book has grown. Rest of the MSME book and the corporate book is yet to register growth. Even in the last year, most of the retail growth has only been the driver for advances growth. So once MSME and the corporate book starts growing along with the capex, I think PNB should be in a sweet spot. So initially hold for a target of somewhere around 105, 110.
Okay, got that. Sounding positive on PNB. Rajat, is that your view as well on PNB, that this is a good one to hold on to for right now?
First of all, I do concur that it is a good stock to hold on. But at the same time, I would say that the last low, that was 69.85, posted a few days back, that can be used as a stop loss, but provided the investor is willing to re-enter again when it shows strength. But suppose if one were to keep it for the longer term, say the medium term to say long term, then I would say that continue to hold on with a stop below 50, and on the upside, my target initially the last high, that was 84, 85, because 85 to 89 would be a window for PNB where a lot of supplies are likely to come. It has come down from those levels. Again, it might face some pressure. After that, the next target would be 96. And once 96 is taken out, PNB would march ahead, and 125, 130 would be the target. So for a long-term investor, medium-term investor, it's a hold. But for the short-term players, put a stop loss below 67.
Okay, that is on PNB, both the technical as well as the fundamental view. Let's get in another query now. We have Archana Rai who writes in. She's actually on the line with us from Madhya Pradesh with an investment query, and she wants to invest in PI Industries. Archana, good afternoon, and thanks for writing in to us. So you want to invest in PI Industries at current levels. Take us through, what you're in.
Yeah, good afternoon. I want to invest in PI Industries. I'm keenly looking at it, but don't know at what levels I should get into it.
Okay. Any reason why you've decided on PI Industries?
I've heard on your channel a few analysts talking about it and saying that it's a good buy and a good share. I'm a long-term investor.
Okay.
So I want to invest in good shares. Yeah.
All right. Let's ask our guests what they think. Sharad, she's a long-term investor, wants to get into PI Industries. The stock, however, has not done much, for a while. Do you think that things could turn and it makes sense to get in at these levels?
Yeah, at current valuations, I think it does make sense to get into the stock. They have some dominant positioning in some of the chemicals they produce. The R&D desk is pretty strong. They are spending 3 to 4% on R&D regularly. And I think the recent acquisitions also will need to merge into the numbers gradually, and that should also give some fillip. The company is guiding for 18 to 20% kind of growth. I think that should be very easily achievable by the company. And the chemical downtrod that we have seen over the last, say, 6 to 9 months seems to have ebbed now. So the raw material pressure, etc., should not be there, and demand should return to normalcy. So that should be very positive for PI, and they would continue to grow at 18-20%. And that is a very healthy growth rate for a company. For FY26, we are expecting the earning to be somewhere around 140-45 rupees. And I think large stock growing at around 20-25% should easily command a 30-35 kind of multiple. So for a target of 4,500, I think PI Industries does look like a good investment from current levels.
Okay, all right. And what would your recommendation be, Rajat, on PI?
I would say that one can buy, but do not buy the whole quantity right away. At this juncture, we can buy partly and keep a stop loss below 3,200. Because 3,200 is a strong support level for this. And this stock has already corrected by more than 61.8% from its top. I mean, the Fibonacci is constructed based on the last major low and the last major high. So based on that, what I would say is that it's a good acquisition. I quite concur with Sharad that it is well worth buying. but buy in a staggered fashion. And once it crosses 3,500, you will see a lot of momentum coming in. But I would say, let me see if it cross 4,000, the earlier high around that level. Let that cross, then we will project higher levels, because the sentiment overall in the chemical industry is not very good at the moment. So it may take some time. She should be a long-term investor and at least hold it for, say, next 3 years or so. In that case, she will reap good benefits out of it.
All right, got that. Archana, I hope that helps you. That is the view coming in from both of our guests on PI Industries. With that, we do need to take a short break on the show, but there's lots more queries that have come in, and we're going to get to all of those in just a bit, so stay with us. Welcome back. You're still tuned into Your Stocks, and we're going through all of the queries that you've sent in with both of our guests, Rajat Bose as well as Sharad Avasthi. So let's get straight to the next one. This is on LIC. Deepak Malik writes in from New Delhi. He says he has 15 shares of LIC at 889. That's a pretty high price. He's making losses in this investment as LIC is pretty, it's close to around 600 rupees, 602 to be precise. And he's asking whether he should hold on or exit at current levels. Sharad, the buy price is very high at almost 890 rupees. The stock has not seen that level for a while. Do you think it makes sense staying invested in this one, or would you recommend getting out?
See, as a long-term investor, I'm very bullish on the prospects of the insurance space, and within that, LIC obviously is one of my top bets because of the fact that it is one of the largest players. And I think the valuations are also very attractive. It is just that the float is large and the participation is too scattered. There is very little institutional participation. So that results in prices not really moving in a particular fashion. So it might take a bit of time because insurance is still an asset business in India, and it will gradually take time to grow. But in terms of valuations, I think it is still trading at 1.3 less. It's trading at very attractive valuations at a discount to the embedded value, which is somewhere around 920 per share. And I think over the next 2 years, there should be growth on that also. So even if you consider this embedded value, I think ideally it should trade at somewhere around 1.3 price to embedded value. So based on that, I have a target of around 1200 on the stock. So I think there is decent upside on the stock, but it might take time. So you have to give it some time of around, say, 1.5 to 2 years, and you could be looking at levels of somewhere around 1200 plus on the stock.
Okay, all right, Rajat, 2 years and maybe you could see 1200 on LIC. Technically, would you concur?
Very difficult to project that kind of a level because there are resistance levels. If you remember, I had been bullish on LIC when it was rising from 560 onwards. But now the critical resistance level of 680 proved to be too much for LIC. Now let it cross that, then only you can think of higher levels beyond that at least. And if it were to fall below 570, 580, then it can go all the way down to retest the lows. So I'm unable to really project the long term for LIC at the moment. And the short term is not very attractive at the moment. So I would have avoided anyway.
Okay, all right. Avoid LIC. That's the technical call coming in. Let's get in another query now. We have SS Kannan who writes to us from Hyderabad. He holds 150 shares of steel strips, which he's bought at around 288, and he wants to know what to do, whether to book his losses or to exit from this particular counter. Well, Rajat, what would you recommend on this one?
You are talking about SSWL, right?
Yes,
Steel Strip Deals Limited, right? It has broken the 9-day, 20-day, 50-day, 3 EMAs. It had a brilliant run from mid-June to about last month, but now it is on a correction mode. If one has already made good money, I would suggest getting out of it because it may take a lot of time before it performs, because it will consolidate between 240 and 220. And after that, when fresh move happens, then only one should be buying. But now one should do well to book some profits.
Okay, unfortunately, I think the person who's written in has gotten at a very high price, right? Almost at 290 rupees. So, Sharad, I mean, of course, it had a great run, like Rajat was pointing out as well. I think from June up until now, it's up around 70%. But since the buy price is so high, what would you recommend?
See, our view is very positive on the stock. They have a new facility coming up, alloy wheel facility, which should start in Q4. And some of the casting facilities are also expected to be operational in FY25. So we expect very good growth for the company going ahead, and the valuations are also not very expensive. So we are expecting a 30-35% kind of CAGR at the profit level. And FY26, we are expecting the earnings to be somewhere around 27-28 rupees. FY26. So based on that, even if a 15 kind of multiple is given to the company, I think which is very much possible, the targets that we arrive at are somewhere around 400. So I think one can hold on for targets of somewhere around 400 on the stock in 1.5 years.
Okay, hold on to steel strips. I'm going to try to squeeze in one more query. We have Bharati who writes in from New Delhi. She holds 300 shares of SJVN, which she bought at 180. She's asking whether she should stay invested or exit the stock. She's bought at 180. This buy price seems a little off to me. I'm not sure. But Rajat, what would your call be on this stock?
See, I think there had been some adjustments at some point in time, because the all-time high, as far as I can see from 2011, it's just about 80, 83, I think. So there has been some problem in the price, purchase price. But I would say just exit the stock, because you just have to look the monthly chart and see what has happened. That is, it's a skyscraper, and the skyscraper is now, implanting those electric shock absorbers from lightnings and all. That kind of thing is happening at the top. So whenever it moves up, there is a lightning or something, it falls. So steel strip, SJVN, one should exit. As far as I am concerned, I would have exited right away.
Okay, let's see what the fundamental view is on this, because Sharad, this entire space has been very hot, right? This entire renewable power space. Is that your call as well? Get out of this one?
Not at current prices. I think SJVN is going in for a very aggressive capex. If you look at the current capacity, it is around 2,000 megawatt. Over the next 2-3 years, this should go up to plus 12,000 megawatt. So that's a huge improvement that will happen. And these are projects that are more or less done. And beyond that, they have a target of scaling that up from 10,000 to another 15,000, 12,000 to 45,000, 50,000 megawatt. The only flip side is that there would be a lot of debt, a lot of dilution probably on the stock, because a lot of equity content would be provided by fresh equity raised by the company. So that is one risk. So maybe every top line increase will not translate into that kind of bottom line increase for the company. But even then, I think that over the next 2-3 years, it should easily report somewhere around 6.5 rupees. So considering that, I think the long-term targets over the next 5-6 years, if you can hold for 5-6 years, you could be looking at somewhere around 170, 180 also. But in case you get something around 110, 100, 110 around the next, say, 6 to 7 months, then it makes more sense to exit the stock. Because in terms of price to book also, even if it trades at 2 to around 1.5-2 times, even then the targets would be around those levels. So I think it's a good bet to hold on for the long term for targets of around 180. While if you get something around 90 to 110 over the next, say, 6 months, then it makes sense to exit.
Okay, all right. Well, Sharad, as well as Rajat, we're going to leave it on that note. It's always a pleasure listening to your views. Thanks very much for joining in and speaking with us. And do remember, viewers, that you can always email us all of your questions and we will address them with our experts on the show. We leave the markets with a little bit of weakness. So we have the Nifty, which is down around 65 odd points, mid caps flat, Bank Nifty down 180. Closing bell up next.